can't see them, and that's why I asked you to bring them with you. So please do bring them. I might put them on the screen and point at something, but clearly you're not going to be able to see all the detail of it if I have an entire income statement or profit and loss statement up there on the screen. So that's a heads up for Wednesday. Please bring Marks & Spencer's income statement with you. Okay. From last time, right, I actually want to go back to last week's slides because I know that we kind of skipped through some of this quite quickly. I was intending to put this up on the whiteboard, but I think if I did that, half of you wouldn't be able to see it. Can you... Actually, I've got on here already. We've talked about conceptual frameworks, yeah? And we talked about that one of the things that the conceptual framework did was to set out the qualitative characteristics of financial information. So what should financial information be like? Yeah, and we talked about financial information should be relevant and should faithfully represent what it says it represents. Yeah, and we talked about. Can anybody remember what were the aspects of faithful representation? How do we know if something faithfully represents something? Yeah?
It's neutral and I think like free of mistakes or errors.
Yeah.
And also it's not biased.
Neutral is the same as not biased.
Yeah.
Yeah.
And also it's complete.
Yeah.
So.
Yeah. Complete, neutral, free from error. Yeah. Mm-hmm. So that's our things that come into our faithfully represent. Relevant. Do you remember what relevant? How do we know something's relevant? The essential thing to remember with relevance is that it could make a difference to somebody's decision. So if a piece of information makes a difference to what you would do, then it's relevant information. If it makes no difference whatsoever in your decision, and this might be a hypothetical person's decision, then that's deemed to be irrelevant. Okay. Okay. So just skipping back to last week then, just to I don't want to skip over these too quickly. So we've got relevance, influence users, and materiality. So materiality is part of that. So if something is too small, if it's so small that it doesn't influence anybody's decisions, then that makes it irrelevant. Okay. So if something is enough to influence people's decisions, then that makes it relevant. If it's complete, neutral and free from error, that means it's a faithful representation. And this is what we want financial information to be like. Okay? Is that alright? Then we looked very briefly, so those are fundamental characteristics. We looked very briefly at the other qualitative characteristics. Comparability, I think we talked about last week. So it's a good thing if financial information can be compared with other financial information. Yeah? What would you want to compare it to? Yeah, go on then.
Well, should the companies to competitors?
Yeah. Yeah. Compare to competitors. Anything else?
Industry benchmark.
Yeah. Industry benchmarks. Yeah, excellent. Anything else?
Previous time.
Sorry?
Previous time.
Yeah, exactly. Yeah, previous year. So I think those. I'm sure you can think of other things as well, but I think those are the main things. You might want to know, how does this compare to last year? How does this compare to my competitor? How does this compare to the industry? So if financial information is easily comparable, then again that is a good thing. Verifiability. That means you can verify something, you can trace it back to the to where it comes from, so maybe to an invoice. We talked about how you might value a building at the cost of the building, and that would be good verifiability because you would be able to look at the invoice and say, oh yeah, that is how much it cost us to build. Okay, so ideally things would want to be verifiable. Can't always verify everything. but this isn't ideal that we would want to aim for. Timeliness. Again, thinking about whether you're going to influence users' decisions, which is fundamental, needs to be on time to do that, doesn't it? If your information is very late or delayed, then that detracts from the quality of the information. So in a way, there is no point in spending loads and loads of time building the most complete and perfect set of accounts if by the time you've done that, your investors have moved on and used something else. That would make the information useless. So timeliness is also important. Understandability. This is a real challenge in accounts, particularly some complicated areas. If, for example, you want to account for retirement benefits, pensions, there's a lot of complicated things that you need to take into account. And again, an ideal that we want to aim for is for what you have done to be understandable by the reader. Again, what's the point of it being the most perfect, accurate representation if nobody understands what you have done? So we've got some tensions there. These might not necessarily always be possible, but this is an ideal that we would like to aim for, and those ones are your enhancing characteristics. Is that all okay? Yeah. So this is set out in the conceptual framework. This is what we're aiming for with financial information. Right, we talked, I don't think we actually got onto to going concern. Can anybody tell me what we mean by going concern? Yeah? Yeah, exactly. Yeah. So the business is going to continue in the future. So if the business is a going concern, that means that, so if you think about Greggs, for example, are you all familiar with Greggs? Everybody familiar with Greggs? Sorry, have you just come over from a class together? I am sorry that we've got to be all the way over here. If you're familiar with Greggs, something being a going concern is the difference between Greggs being something that you all know about, where you might want to go if you wanted to buy a pasty or a donut, versus it just being a collection of shops and ovens and pasties and donuts. So you could have a collection of shops and ovens and pasties and donuts without it being Greggs. Yeah. So Greggs is like a business, and you would expect it to continue into the future. Businesses are doing going concern assessment, and that means they think about, actually, is this viable as a business, and does it continue to be viable into the future? Is it going well enough that we can expect it to be ongoing as a business rather than as just a collection of things into the future? Okay. Does that make any sense? Yeah. How far into the future do you think we need to look? Bit of a trick question, really, because it isn't really an answer. And it used to be that we used to think about 1 year into the future, but there was a lot of criticism of that. Why 1 year? That's a bit arbitrary. Shouldn't you look longer? What about sooner than that? So that's been taken out. So there isn't any time limit posed on that. It's just what you can foresee in the future. Does it look like the business is a going concern or not? So accounts are prepared on the basis that a business is a going concern. So if you're doing the accounts for Greggs, you would have an assumption that the business is going to continue, and that makes a difference to how you prepare the accounts. So for example, if you were going to value one of the Greggs shops, then you might think about that differently. What is the value of that shop with its Greggs logo on it? And you've got a stream of future income for how many pasties and donuts they're going to sell, yeah? Compared to if Greggs had gone bust and all you were doing was valuing the building with maybe with the ovens in it. Yeah? Am I making sense? Yes? Okay. All right, so going concern is a general assumption that the business, whatever it is going to keep going. Okay, key definitions. These are really, really basic, but as I've said, one of the things that a conceptual framework does is to set out exactly what some of these really key things are. So what is an asset? An asset, the official definition that the IASB has come up with, is a present economic resource controlled by the entity as a result of past events. Okay, you don't need to memorise that, but that is set out in the conceptual framework so that if at any point you were thinking about, how do I value something, or is this an asset, or actually, what is income? Once you've got a definition of an asset, you can think about what income is by thinking about, well, does it increase our assets? Well, how do we know? You need to think about what an asset is, okay? So this is what the agreed definition of an asset is. So present economic resource, something that an entity has, that's controlled by the entity, so there's no use having it if somebody else has got control over it, as a result of past events. Economic resource is a right that has the potential to produce economic benefits. So from this here, so you might think an economic resource, that could be a shop, or it could be a printer, or it could be an oven, or anything that you can use to generate stuff that you can then sell and then you can get money for. Okay, so anything. The potential to produce economic benefits. So it could also be like a trademark or something like that, something that you could that you can get royalties from. Okay, a patent. Okay, so not limited to physical things. Liability is again present obligation, so something that the entity is obliged to do to transfer economic resource as a result of past events. Obligation is a duty or responsibility that the entity has no practical ability to avoid. So it can't be that you're intending to make a charitable contribution, yes, because you could decide not to. But if you've got an invoice that you have to pay, then that would be an obligation. Okay, so again, you don't need to memorise those. What I'd like you to be aware of is that these things are set out in very basic terms, and that is so that accountants and standard setters and accounts preparers can go back to the conceptual framework and reference that if they should need to. Prudence, I'm going to skip over quickly because I think I mentioned that last time. It is an old concept in kind of UK GAAP that accountants should be conservative, and this has been there's been a lot of very heated debate about prudence and conservatism versus neutrality, and IFRS is all about being neutral. If you do an estimate, it shouldn't be a prudent estimate. Okay, you shouldn't err on the side of caution. Your estimate should be straight down the middle. So there's a link there which I won't go into, but you can have a look at in your own time. That just kind of discusses that. It's quite an old one from 2013, but it's been it's certainly alive. It's still alive to debate. Yeah, 2015, and you can find newer things as well on the same theme. Okay, right, that is the end of last week, so I shall stop there and continue with this week. So from last time, so companies are required to produce an annual report that includes financial statements that are set out in law. You don't need to worry about which laws, but be aware that is the statutory requirement companies have to do. Financial statements are prepared in accordance with certain rules and are audited. Okay, this contributes to their reliability, and that was one of the reasons why we said that the financial statements part of an annual report can be relied on more than the rest of the report that doesn't have to comply with those rules. Financial information must be relevant and faithfully represent what it purports to represent. That's what we just discussed. those are the concepts underlying the conceptual framework, and then the conceptual framework underlies the accounting standards, which is what the accountants have to follow when they prepare their accounts. Okay, so that's where we're at. Oh, and we've got IFRS. So IFRS is the international reporting standards, which we're going to concentrate on because that's what is used in the UK and Europe and a lot of the world. Okay, I have organised a lot of these slides according to accounting standards. I have put the accounting standards numbers on there because I'm an accountant and that's how I know them. And because if you ever wanted to look one of these things up, then it's helpful to know the number. But don't feel that you need to memorise the numbers at all. I'm not going to test you on the numbers. You don't need to know them. These are some of the key standards that pertain to the income statement. So first of all, presentation of financial statements is dealt with in IAS 1. This relates to the income statement but also other parts of the accounts, but it's worth having a look at first. I've done something wrong there because it didn't look like that when I looked at it. Okay, never mind. The objective of IAS 1, oh, by the way, there will be somebody in the room, or maybe more than one person, who's wondering what IAS and IFRS mean. This is International Accounting Standard, this is International Financial Reporting Standard. They essentially mean the same thing, there is no difference between the two. The older ones are called IAS and the newer ones are called IFRS, and you don't need to know that. But there'll be somebody who's worrying about it. Okay, so IAS 1, International Accounting Standard 1, is the objective is to prescribe a basis for presentation of general purpose financial statements. So it sets out how we present financial statements to ensure comparability, both with the entity's financial statements of the previous period and with the financial statements of other entities. We've already talked about how comparability is something that is desirable for financial information. So IAS 1 sets out the framework of how we do that. Oh, sorry. I'm sure I've got the rest of it here. Have you got the rest of that in your slides so you can actually read it? IAS 1 sets out the overall framework and responsibilities for the preparation of financial statements, guidelines for their structure, and minimum requirements for the content of the financial statements. Okay. I think of it as back to basics. This is the back to basics standards. Yeah, this tells us the very basics of what needs to go into accounting standards. So overall requirements. What are the overall requirements of financial statements? Things like there has to be a balance sheet. Yeah. The structure, what should they look like? The minimum content, what is the absolute minimum that by law companies can put in there? And some overriding concepts. So IAS 1 specifies that accounts have to be prepared using the going concern concept. Yeah, so any accounts that are out there, you can assume that the business is going to continue for the foreseeable future. The directors have made that assessment. Accruals concept. Are you familiar with accruals? Yes? Yes? Okay. So this is, just the idea that we have to match the income or expenditure with the period in which it is due. So one of the other things that IAS 1 says is that the statements have to be prepared on the basis of matching or accruals. Current and non-current. Do we know what we mean by those? Yes? Somebody tell me what's a current asset? Short term, yeah? So very, very simply, current is short term and non-current is long term. Yeah? What would be the difference between short term and long term? How do you know whether something's short term or long term?
Like short term, like stock, like the non-property, like property.
Yes. Yeah, so good examples there. So with with assets, so non-current, a long-term asset would be your property, so like this building, and a current would be stock, so like your pasties at Greg's, whereas the shop would be your non-current, and this is defined in accordance with trading cycles. So if it's something that you sell, then it is then it's a current asset, whereas if it's something that you use over multiple trading cycles while you are selling other things, then that's non-current. Okay, so if you have a van, is that current or non-current? Non-current? Yeah? Anybody think it's a current asset? No? Answer is it depends on the business, So what if you were a business that sold vans? If you're Nissan, if you're a business that makes vehicles and sells them on, and you've got lots of vans, they would effectively be your stock. So therefore they would be non-current. But if you are a company that, I don't know, makes deliveries, then your vans would be part of your property, plant and equipment. So current, non-current depends on the business, and each business would need to think about that when they prepare their accounts. Okay, good. Right. Really back to basics. The financial statement should be clearly identified within the annual report. So if you've got the 164 pages or whatever of annual report, it should be obvious which bits of that are the financial statements. And they should prominently state the name of the organisation, the year that's being reported, the currency. And these are all things that are worth looking at. And again, it's set out that those things are required to be prominent, so it shouldn't be confusing. Minimum content. Again, you don't need to learn these, but financial statements are required to have a statement of financial position, also known as a balance sheet, a statement of profit or loss, and other comprehensive income, also known as an income statement, a statement of changes in equity, a statement of changes in a statement of cash flow statement. So those are our 4 primary statements that are required. We're also required to have notes. I don't like this table here. Also required to have notes of the accounts, including the accounting policies, and comparatives. So comparatives are your last year's figure, so that enables you to have a comparison. How's the company done this year? How does that compare with last year? How have things changed? IAS 1 also sets out the detailed content of each of these primary statements, which I'm obviously not going to put up on the slide. I don't think you would find that very helpful, but it sets out some minimum content of those. There are various other requirements. One of the most interesting ones I think to be aware of is judgments and key assumptions. So if there have been judgments and key assumptions made in preparing the accounting statements, then those have to be disclosed, usually in the notes. Can anybody think of anything where there would be a judgment or an assumption? You can get some really big ones and they might not be that obvious to you from this point of view. If we're thinking in the context of the income statement, then an example would be, when have you earned? So we talked about matching concept, accruals. So companies are entitled to recognise, or they should recognise their income when it is due to them, and that means they don't necessarily wait for the cash to come in. If you've sold something, a customer's agreed to pay it, and you've delivered it, then that is accounted for in your sales, irrespective of whether the customer is actually paid or not. We're all happy with that concept? Yes? Yeah? But sometimes whether a customer has actually agreed to pay, and whether they are whether the company has fulfilled its obligations, whether the company has delivered whatever, is not necessarily that straightforward. I think if you think about holidays, that's a good example. So if you are a travel agent and you sell holidays, then the customer might come in and buy a holiday, and they might pay a 10% deposit, or might just pay £100 or something like that. So at what point has the holiday been sold, and when should the holiday company include the cost of that holiday in their not the cost of the holiday, sorry, the sales, the income from that holiday in their accounts? Yeah. You don't need to know the detailed answer to that question, but just be aware that it's not necessarily straightforward. Okay? If you sell a jumper, if you go to Marks and Spencer's and buy a jumper, then I think it's quite clear, like when you've got the jumper and when you owe the money. Whereas with a holiday and other things like insurance or mobile phone contracts and things like that, it isn't as straightforward as you hand over the money and you get your stuff. It's not necessarily a straight transaction. So there are lots of guidelines around those sort of things, but there are judgments and assumptions that have to be made, and if company has made those sort of judgments and assumptions, then they will need to disclose what they are, so you can read about them in the notes to the accounts. Okay, statement of profit or loss and other comprehensive income. Right, so we've got two parts here. So we've got a statement of profit or loss, and this is like your normal stuff, yeah. So you're selling jumpers or whatever it is that your company does. The income, the cost, and the profit and your expenses would all come into your normal profit and loss statement. And I think if I said profit and loss statement, that everything that you would immediately think of would probably come in this bit, yeah. So this is kind of normal stuff. And then we have other comprehensive income, and that is more weird and wonderful stuff that you probably wouldn't think about. So an example of other comprehensive income would be if you had, let's say we've got a factory that makes jumpers, and it's in China, and they are continuously making the same amount of jumpers for us last year and this year, and there has been no changes to the to how many jumpers are sold or the design of the jumpers or anything. But what does happen is there's a fluctuation in the currency, and as a result of the fluctuation in the currency, the value of that factory might be more or less in the financial statements than it was last year. Okay? And that could be nothing to do, there might be nothing that had happened with the building or anything that happened inside it, but because of the differences in the value of the pound, that could change the value of the building in the statements. So the company could end up with either a gain or a loss that is purely due to currency. Does that make sense? Yeah? So you could, if there was a gain, yeah, then that means you've kind of got some income, but you haven't really, because you've got exactly the same building and the same jumpers as you had before, so you haven't really got a gain. Okay, so that would be called an unrealised gain. So that would come into other comprehensive income. So this is unrealised income. Okay, it could be an unrealised loss. Okay, things like that also happen with if you've got pensions liability. So you might have a promise to pay future pensioners, and there might be a very big estimate of how much you owe future pensioners, and then you get an actuary to do that estimate for you. And if the actuary came in and redid their measurements based on new life expectancy data, then all of a sudden you might owe more than you did before. And again, that is not really due to anything that you have done, and it doesn't affect the ins and the outs immediately. So that would again go through other comprehensive income. So you might have a bigger or a smaller liability than you had before, but not, it wouldn't be anything that was sort of ordinary profit and loss. Okay? So make this distinction. So the profit and loss account tends to deal with realised things. That's basically ordinary stuff, whatever the business does in its ordinary course of its transactions. Other comprehensive income tends to be stuff that happens kind of under the surface. It's called unrealised. Is that okay? Yeah? So in order for your accounts to be able to add up, you have to be able to take account of both of these things to get your comprehensive income from the period. If you only take account of those ones, then you're, you have your balance sheet for last year, the balance sheet for this year, and your difference should be your profit and loss. Yeah, you need both of those to make up the difference. If you forget about that, then it won't add up. Okay, so we have to have both of those to get to our comprehensive income for the period, which is required to make our accounts. You don't need to know in lots of detail about them. I think you need to be aware that they're there, so that when you see them, that you recognise that that's what it is. So profit and loss is probably, if you're analysing the financial statements, is probably what you're most interested in. On the other hand, there can be some big stuff in there that you might want to have a look at, but that really depends. There's more likely to be one-off kind of things. Okay, so IAS 1 says that these things both have to be disclosed, so you have to disclose the unrealised and the realised transactions. And you can do it in 2 statements or 1 statement. Okay, so that's an option for companies to decide. They can have a statement of profit and loss and a separate statement of comprehensive income, or they could just do this and put it all together, but it would have to be in 2 parts. Right, I just want to have a look at the Marks and Spencer's one now, so we can actually see what I'm talking about. There. So yeah, in order for me to get that small enough for it to be on the screen, as you can see, you can't actually see it, but hopefully you've got that in front of you. If you haven't, don't worry for today, but please do bring it on Wednesday. So you can see that Marks and Spencer's got, I don't know, well, it looks like 2 separate statements to me. So we've got our consolidated income statement here, and then we've got our statement of comprehensive income underneath here. So this is all our ordinary things in the top half, yeah, and then we've got our kind of one-off unrealised transactions that happen in the bottom half. Okay, so we're going to keep coming back to those, and I don't want to have a look in any kind of detail, but obviously we've got revenue on the top line. What's another word for revenue? Sales, yeah, or turnover. Sales probably, sales, turnover and revenue all mean the same thing, yeah? And again, they're used interchangeably, and I'm not going to apologise for mixing those up either, because again that happens in the real world. So sales revenue or turnover is your top line. That's essentially the money coming in. We've not got very much detail here at all. We've just got our operating profit. Yeah. Yeah, so I think that's pretty condensed profit and loss statement there, and other companies might have much more detail, and you'll be able to have a chance to look at some different ones when you get to the seminar. Statement of comprehensive income, anything to notice on there? I would always look at, we talked about materiality, I would always, when looking for something like this, just look at the big numbers, yeah? So, and the biggest number on here is 132. and that is fair value movement in the comprehensive income, cash flow hedges and net investment hedges. So this is to do with financial instruments, so you don't need to be particularly worried about that, but it's to do with investments that Marks and Spencer have done and the value of them has changed. So if you invest in the stock market, things can move up and down. It's worth noticing they've got quite a big gain on it this year, but they've got an even bigger loss last year, so there's some quite significant movements going on there under the surface. We've got a foreign currency translation difference, which is what I was talking about with your property in another country. And I think just be aware that some of these things can be quite big. So like for 132 here, our entire profit for the year is only 37. Yeah, so these are quite sizable. Okay, and then that brings us to our total comprehensive income for the year. Okay. Any questions? Okay, statement of profit or loss must show revenue, has to show expenses. You can say the Marks and Spencer's one didn't show expenses, but it gave you enough information that you could work them out because it showed you the revenue and the operating profit. Gains and losses from the sale or reclassification of some financial assets. That was one of the things that we saw in the bottom there. Finance costs, so that would be any interest on loans and things like that, any interest payments that they have to make. They have to be shown separately. So interest doesn't get mixed up with other kinds of costs, it has to be separate. Share of profit and loss of associates and joint ventures, again they have to be shown separately so you don't mix them up with the main kind of business. Tax is another one that has to be separate, and discontinued items, which we will come on to. Gross profit is optional. When you come to analyse financial statements, if your company shows you a gross profit figure, that can be really, really helpful. But it's not a requirement for companies to disclose it. So, and we saw that Marks and Spencer's didn't have it there. So if your company shows, or you're looking at some statements that show gross profit, then that's great. If they don't show gross profit, then you can't necessarily find it anywhere. They don't actually have to disclose it. Okay, so companies don't have to put the cost of sales gross profit out there, and they might want to keep it confidential. Okay, we just looked at this. I can't actually see a clock from here. What time is it? Right. Exceptional and non-recurring items. Sometimes we have things that happen only once. So you might, if you're Greggs, you sell pasties every day. If you're Marks and Spencer's, you sell jumpers every day. But you might have some things that happen just once. So the examples I've got here: severance pay. So if you made somebody redundant and gave them a payout, then that would be a one. You'd hope that wouldn't happen every day. Pensions top up, if your actuaries told you actually you're not saving enough money in the pension pot for these future pensioners and you had to put some money into it, then again that would be a one-off thing. Sometimes companies might do a restructuring if they make some significant changes to their business, and again that could lead to some one-off costs. Little litigation settlements, again hopefully they would be one-off if the company's found negligent, or for example in court, and had to pay costs, so pay a settlement. If you've got these one-off items, then they should be reported separately rather than just get mixed up with ordinary expenses, because they're quite different. So if these things are happening and they're big enough to matter, then IAS 1 requires them to be shown separately. So that means as the reader of the accounts, you can separate out those things, and you can look at kind of trends over time without these things skewing the underlying effect. The FRC, the Financial Reporting Council, has noted that this is an area for improvement, and they said that companies don't present exceptional items consistently, and they said that it's essential that investors should be able to understand and rely on the trends in the profitability of companies. So if I go back to Marks and Spencer's just briefly, you'll notice that the top half of the accounts, we've got more lines than the bottom half. So we've got here, we've got our profit before adjusting items, and then we've got adjusting items, and then we've got a total. So we've got 3 columns, and then we've got last year's. So this is effectively our exceptional items, yeah, our one-off things. So Marks and Spencer's have put them into a separate column. So the effect of that is that you can think about those things separately, and if you are wanting to think about what is the trend in the performance of this company, Marks and Spencer's are kind of saying, well, don't just compare, you know, this number to that one. Actually, you need to compare this one to this one, yeah, because these things are all kind of one-off items, yeah. You might notice that frequently the one-off items, if you take them out, then the performance looks better, yeah. So by doing this, Marks and Spencer's has managed to report £417 million profit rather than £37 million. So maybe that's, you know, that's a good thing for them. If you can look at it and think, oh yeah, Marks and Spencer's have done really well, they've made £417 million profit. They didn't really, they made £417 million profit on their ongoing stuff, yeah, but overall, after the one-off items, they've only made £37 million. So there's a question there of how much is this a really helpful thing for you to be able to look at the trends over the years, and how much is that the company managing your impression of them and making their profits look good. So be aware of that. If you've got things in this column, I would say you need to know what they are, yeah? So especially if they're big things in that column, which here they certainly are. If you've got £417 million profit, but 379 of it is wiped out by one-off things, it's really important to know what those one-off things are. If it was only, you know, 2 or 3 or 4 or something in here, or even 20 or 30, you might not bother so much. But definitely at this level, you need to be thinking about, okay, what are those things? The other thing I would say is, with my very sceptical hat on, is if the exceptional things are happening, if we've got £438 million here and £514 million last year, did they happen the year before as well, now they're going to happen next year? Is it really that exceptional if it's happened 2 years in a row? So again, I think an understanding of what that is required there, and I think this is one of the things that the FRC is talking about, that companies should be more consistent with their reporting of exceptional items. So this requirement for exceptional items to be presented separately can be really, really helpful for you as a reader of the accounts, but equally it can allow the companies to present the accounts as looking a bit better than they are in actual fact. Okay, so in summary, IAS 1 sets out the basics of how financial statements should be set out and what needs to be disclosed, our back to basics standard. Profit or loss and other comprehensive income must both be disclosed, and exceptional items are shown separately. Have I got time to do revenue from customers? 5 minutes. Let's do revenues from customers and then we will stop. Okay, so IFRS 15 is a new standard in the UK. So we used to have IAS 18, and this changed from 2018. So accounts from 1st of January 2018 have to use the new standard. So any accounts that you look at now will be reported according to the new standard, but older ones won't. They have a definition of income, which is that it increases. Income is an increase in economic benefits during the accounting period in the form of inflows or enhancements of assets. Yeah. So you've got an income if your assets have gone up, or decreases in liabilities that result in an increase in equity other than those relating to contributions from equity participants. Okay, so it's not just to the owners putting their own cash in, but anything other than the owners putting their own cash in that results in assets going up or liabilities going down, that is counted as income. So that's, again, very basic definition that we can go back to, but as I've already hinted at, it can be really tricky. Principal or agent. If we go back to the holiday example, if you were a travel agent, then if you sold somebody a holiday, if you went to a travel agent to buy a holiday, you might spend £1,000 on a holiday, maybe, if it was a really good one. Maybe you went skiing, I don't know. Then you might pay £1,000 for your holiday, but the holiday operator might pay £900 to the company that provided the flight and the company that the hotel that put you up, etc. Yeah. So have they earned £1,000 in sales, or did they just earn the 100? Which is the difference between, you know, what they did, because effectively that 900 that you gave them that relates to the flight and the hotel, etc. It's just like it comes into them and they have to pay it straight out again. Yeah. You don't need to know the answer to that question, but be aware that those type of questions exist, and it is not necessarily straightforward. That is a principal or agent problem. Yeah. So if it makes a difference whether a company is a principal or agent, whether they're deemed to have earned the money or not. Discounts can be tricky. If you offer trade discounts or early payment discounts, then have you earned that money or not? Deferred payment, buyers have a set in time for Christmas and pay us in 3 years. When did you earn the income? Free servicing, you know, you can have a washing machine and we will service it for free for the next 5 years. How much have you earned in respect of the servicing? Okay, so there are lots and lots of details on how those should be accounted for, but you do need to know. What I want you to appreciate is that it isn't always as easy as selling a jumper, and if you buy a jumper for £20, then it costs £20 and the company has earned £20. With other different types of things that you can buy, it can be a lot more complicated than that. And if you're looking at some accounts where they sell things like furniture that you pay for in 3 years' time, or like holidays that might be a principal or an agent relationship, etc., then all of the revenue recognition will be set out in the accounting policies note. So that would be something where it would be useful to look at the accounting policies note to find out how they determine when they have earned their revenue. This is the steps that are set out in the accounting standards. So first of all, you have to identify the contract. Yeah. Again, it's dead straightforward. If you're buying a jumper, then effectively the contract is that you get the customer gets a jumper in exchange for £20. But for a holiday or a washing machine with servicing, that would be a lot more complicated. So it's a case of finding out what the contract is. Identify the performance obligations. So this is a bit of a word that they use in accounting in standards language. So performance obligation for if you're selling a jumper would be to give you a jumper. If it's a washing machine with servicing, then you'd have to think about actually what are we obliged to give. Yeah. Determine the transaction price, £20 or something more complicated, and then allocate the transaction price to the performance obligations. One of the things that you might have to do is split up the sale of your washing machine and the servicing and think actually we've got 2 different transactions there. And then you recognise the revenue when the performance obligation is satisfied. So if you've sold a washing machine, then you should be entitled, the company is entitled to the revenue from the washing machine, but if it hasn't done the servicing that it's promised to do, then it hasn't earned that revenue yet. So in that case it would need to be, the sales price would need to be split. So you only recognise the bit that you have delivered on, and you recognise the other bits when you have delivered the performance obligations in those bits. Okay, my summary of that diagram is revenue is recognised when performance obligations are satisfied. So whatever the company has to do to earn the revenue, when they've done it, that's when you can say that you've made the sale, that you've earned the money. Check the account policies, note the tricky areas. So if your company is doing something complicated like that, then it will be set out in the account policies note. Okay, I shall stop there and we will continue on Wednesday. When you come on Wednesday, please bring the Marks and Spencer's income statement, and will you bring a calculator as well, because we're going to do some calculations, and I think it would be helpful if you can do that as I do it.